Assalamu alaikum to all of you and a very good evening from my side. My name is Hamad Sarwar and today is day 4 of this practice to pass webinar. I hope you all are enjoying this webinars and I think these are useful tools for the exam preparation. I hope that these webinars are giving you the benefits in terms of increasing the confidence towards the examination and the concepts, the core concepts of this paper, and in fact, how to attempt the paper. So I have received few answers from the students who have done two questions. That was the part of the assignment, that is Haverford, and I have given the question Duggan. So the first requirement is to prepare these two statements on the constructive response workspace rather than solving on the notebook or on the Excel sheet. And the second feedback that I wanted to give to you guys, that uh, mostly students have no knowledge about how to present the financial statements in the CRQ workspace. They don't know how to prepare the income statement. They don't know how to prepare the proper, what's the proper format, what should be the presentation style for attempting the paper. So that's very surprising for me that students have a very little knowledge of the CRQ workspace. So today it's my plan to solve one question of the consolidation on the constructive response workspace so that you all will understand how to present your answer in the examination. So as per the planner, we will not be able to cover three accounting standards in the last session. That was IS 21, IS 8, and IS 37. So first of all, we are going to attempt these standards, and then we will switch on towards the topic consolidation. And according to my special plan, now, right now I'm talking with those students, especially got flunked previously. So according to the special plan that I have shared, that you all need to do for 24th of February, you all need to do the revision of the practice to pass slides that I have given to you guys, and MCQs of the key IFRSs. We have covered IS 16, IS 2, IS 38, IS 36, IS 40, IS 41, IS 12, financial instrument, IS 32, IFRS 9, IS 20. So these are almost all this, or these are the standards that we have already covered. So all you need to do is to do the practice from the Kaplan, or you can select the BBP kit for these standards from section A and section B. So that's the plan for 24th of February. And all of you must listen the cash flow video which I have shared on the group. So if you have done all these requirements, then that means that you have fulfilled the plan of the first day of the spatial plan. So if you follow this spatial plan strictly, then it will be very beneficial for you. And for those who got flunked previously, will definitely pass the exams. The second, today is 25th of February. So according to the plan, you need to do the revision of the practice to pass. Then HS assignment. HS assignment means the assignment which I'm sharing with you guys in the PTP. MCQs of the consolidation for the Kaplan kit. This is the requirement for today. Cash flow is not that important with respect to the examination, but you should know how to prepare the cash flow statement because it might be asked in section A or B, or it could be the part of section C. So you should know how to prepare the cash flow statement, but its the importance is comparatively less. That's why I've shared my video link with you guys, and I'm not covering the cash flow topic in this P2P session. So let's start the session for today. So we are going to start with the topic IS 21 that is related to foreign currency. This topic was recently included, I think, in 2019 in the syllabus. So it will be considered as one of the important area for section A, B, or C. Yes, EPS video will be provided to you guys by tomorrow, but my recommendation for all of you is to first uh, try to cover the videos of day 1, day 2, and day 3, and the video link of the cash flow. And with reference to the EPS, I will share the video link by tomorrow. Inshallah. Now, foreign currency, talking about the topic, foreign currency means IS 21 says that first you need to identify your functional currency. Functional currency, I'm representing the word functional currency with FU, and any currency other than the functional currency will be your foreign currency. First of all, you need to identify your functional currency. So how you can identify your functional currency? Functional currency means the currency in which you have to record all your transactions. So you maintain the books of accounts in a particular currency, that will be considered as your functional currency. So how you can identify your functional currency? So functional currency will be dependent on the primary business economic environment. The currency of your primary economic environment. Economic environment. The currency of your primary economic environment will be considered as your so the currency of the primary economic environment will be considered as a functional currency. So how we can identify the primary economic environment? The currency in which we are making the sales, in which we are making most of the expenses, in which we are borrowing the loans, in which we have done investment into the business, retaining profits. So that's the simple thing is, in order to identify the functional currency, so the currency in which you are dealing mostly in your business will be your functional currency. So suppose my functional currency is dollar, then all other currencies other than the functional currency will be considered as foreign currency. Okay. So foreign currency transactions. So how to deal with the foreign currency transactions? Initially, foreign currency transactions should be translated into the functional currency using the spot rate. Spot rate means the rate at the date of the transaction. So all foreign currency transactions should initially be recorded into the functional currency using the spot rate of the date of transaction, and at the time of settlement, if the rate varies because of the time duration or changes at the time of the settlement, then the gain or losses that occurs between this period will be recognized in P&L. Similarly, if the company does not settle the transactions yet, then you need to retranslate the data using the closing rates. So you need to retranslate the data using the closing rates, and again the gains and losses will be recognized in the income statement. So that's the overall theme. Can we consider local currency as a functional currency? Yes, if it depends. Usually the local currency will be considered as a functional currency, but the main point is that you should do all the primary economic environment, economic activities in that currency. Like suppose if you heard about the word outsourcing business, so there are a lot of outsourcing business who might reside in a particular country, but they work in USA or UK, and they like call centers. Yes, so their sales will be in the form of in dollars or in pounds or in any other currency, but they are working, like let's say for example from Pakistan or from India or from Bangladesh, but they are making sales from the in dollars, and their main expenditure will be in dollars. So it might be possible that the functional currency will be dollar. Now, at each reporting date, you need to see whether the item is monetary and non-monetary. So monetary items should be retranslated using the closing rate, and its gains or losses will be reported in SOPL. So what are the monetary items? Monetary items include debtors, creditors, investment, and loan. So there are four items that could be considered as a sorry, monetary item: investment, loan. So if there are some outstanding debtors, foreign currency outstanding debtors, creditors, investment or loan, then these items will be considered as a monetary item. And if there are some non-monetary items, like sales account is a non-monetary item, purchase account is a non-monetary item, any other asset other than receivables and investment will be non-monetary items. So non-monetary items should not be retranslated if it is measured at the cost model. But if it is held at the fair value, then the fair value should be translated using the rate at the date of fair valuation measurement. So these are the basic concepts. So let give you an example for this. Suppose we are here in Pakistan and we wanted to buy a plant from USA, and $1 is equals to 100 rupees of Pakistan as a unit, and the transaction is for $1,000. So when you buy the plant from the USA, the cost of the plant will be $1,000. So that's your foreign currency transaction. And as you are staying in Pakistan, so your functional currency will be rupees. So first of all, you need to convert this transaction into local rupees. So the accounting entry should be planned debit and payables credit. And assuming that we are purchasing this plant on credit terms, the accounting entry should be plant debit multiplying 100 into 1000, it will give you 1 lakh. The plant will cost you 1 lakh rupees. So this is my non-monetary items, and this account is my monetary item. So if assuming at the year end, company does not has yet paid all the outstanding obligations, so this account should be retranslated based on the current rate. So assuming now at the year end the $1 rate, the $1 rate is now 120. So definitely my liability has increased from 1 lakh to 120, 1,20,000. So there will be an increase of 20,000, which should be charged as a loss in the foreign currency because your liability has increased. So it will be a loss on the foreign currency. So the 20,000 will be the loss that you should charge in the income statement. And if the dollar currency weakens and the rate goes down, then there must be a gain on the retranslation. I hope it's clear now. Inventories are non-monetary item, yes. Only receivables, payables, investments, and loans are monetary items. So what this loss will be named the foreign exchange loss. Yeah, these are the foreign exchange losses. So I'm giving you just this question to solve it, and then we will discuss later on. Now, Renon also sold goods to an overseas customer on 1st December for 12 million chromets, and $1 is equals to 6.4 chromet. So that is again a very big challenge for most of the students in the examination, that either we need to multiply this rate or divide this rate. So it's very easy to understand the concept, that you should know that which currency is more stronger. So here you can see $1 is equals to 6.4 chromet, means dollar is a strong currency and chromet is a weak currency. That's it. So if you are going from the strong currency to the weak currency, then you need to multiply the rate. And if you are going from the weak currency towards the strong currency, then you need to divide them. That's a simple scenario. So we have to convert, because our functional currency in this question is dollars. So you need to convert 12 million chromet, that is from weak currency to the strong currency. So you should divide the rate of 6.4 and you will get the value. So 12 million divided by 6.4, you got the value of 1.875. So the accounting entry should be the receivables debit and sales credit. In dollars, it's 1.875 million. No entries had yet to be made to record the sale, although the goods were correctly removed from the inventory, and the expense is in the cost of sale. The amount unpaid remains unpaid at year end. So if the amount remains unpaid, this will be my monetary items, and this is my non-monetary item. So you don't need to convert the non-monetary item, only the monetary item will be retranslated again at the closing rate, which is now 6. So when you divide this rate with the current 12 million with the current rate of 6, you got the value of 2 million. So my receivable has increased from 1.875 to 2 million. So there will be an increase of 1.875, 0.125 in the receivable. 0.125 million will be the increase in the receivable. So the accounting entry should be receivables debit 0.125 and income statement credit by 1. So there will be a gain in the income statement. It means that our currency dollar is getting weak. Chromium is getting stronger. Because previously in $1 you got 6.4 chromium, but now it's 6 chromium only. So there should be a gain of 0.175. 750K, no, there will be a gain of 0.175, 0.125. Why we divided with 6? Because 6 is the closing rate, and according to IS 21, if the monetary item has not yet been settled, then it should be retranslated. So we actually retranslated the liability at the closing rate, receivable. Our currency is getting weaker, and how can we get the gain? Because we have to receive the amount. Because it's a trade receivable. So whenever you are going to receive the amount, you will get the benefits. when your currency got weaker. Is the rate is called average rate? No, this is not an average rate. This is a closing spot rate. We do not, we don't need to convert in KR as a function. No, KR chromium is the currency, uh, and in fact, we have bought the goods. We have sold the goods in a country whose currency is chromium actually. The chromium is the foreign currency, and our local currency is dollars. It's not mentioned here that which is our local currency, but it is a part of the long question in which you can see that the company will be recording all its transaction in dollars, and the chromium will be the functional currency. Now, with respect to the income statement and balance sheet, as the question has clearly stated that nothing is recorded yet, then in the income statement there will be a sale of 1.875 and a gain on the foreign currency of 0.125. And in the balance sheet, trade receivables will now be reported at 2 million. That's it. Which is our currency. Okay, I need to show you the question first. Now, look at this question. No, no. Please look at the question. This is the Vernon question in which everything is available to you in dollars. So this question is actually given to you in dollars, and there is an adjustment of note number 2 in which company has sold the goods to overseas. It's clearly mentioned here that overseas customer for 12 million chromate. The chromate is actually my foreign currency, and the rest of the transaction was given in the dollars. The my dollar is my functional currency. Yeah, only monetary item would be translated at the end. It is strong to weak. Yes. Any question? Don't please don't ask that type of question that is not relevant for the examination right now. That it's an understanding level question. Please, you can ask me on the WhatsApp, or you can even call me to know this fact that if the chromium is getting stronger, then why it's the gain. I'm just giving you a simple example. A very simple example to understand. Suppose you need to receive $1,000 from the USA, and we are living in Pakistan. So previously, $1 was equal to 100 rupees, but now $1 is equals to 150 rupees. So what do you think? The dollar is going to be strong, or our currency is going stronger? Rupees is going to be strong, or the our currency, or the dollars? Dollar is getting stronger. Yeah, that's good. Dollar is getting stronger. So previously you will receive 1000 into 100. So previously you will be receiving 1 lakh rupees against $1,000. And now you will receive 1,50,000 rupees for $1,000. So this is a very clear and a simple fact that whenever your currency gets weaker, you will get benefits from the foreign currency. Loss on the foreign exchange, it will be recorded in the income statement. I hope I have cleared the point. Now going towards my slides again. Where is my slides? Okay, that's here. So I think this question is clear to all of you. One last point that I need to tell you guys about. Now, if you have prepared your income statement and balance sheet, assuming in dollars, and you need to present these statements in pounds. So IS 21 says that you can present your financial statements in any presentation currency. So you know that you simply have to multiply or divide a single rate, and your whole in the Excel sheet, your whole dollars financial statement will be considered converted into pounds. But for this conversion, you need to take average rates. You need to take average rates for income statement items, and you need to take the closing rates for balance sheet items. That is again one of the requirement of IS. Is it clear? So the income statement related, suppose you wanted to convert your income statement, which is denominated in dollars, into pounds. So what rate you should adopt for the conversion? So we should take the average rate of the whole year for income statement items. And if you wanted to convert your balance sheet, which is in dollars, into pounds or any other currency, then you need to take the closing rate. So for balance sheet items, because we prepare the balance sheet as at, so you need to take the closing rate. And for income statement items, you need to take the average rate for conversion. Now, moving towards the topic IS 8, this is one of the favorite area of the examiner, IS 8. IS 8 is about the accounting policy estimates and correction of errors. For accounting policies should be consistent. Policies and presentation should be consistent, but if there is a change in the policy, it should be applied retrospectively. Similarly, material prior period errors or previous year frauds should be adjusted retrospectively. But for estimates, IS 8 says it should be reviewed annually, And if there is a change in the estimate, it should be applied prospectively. Retrospective means adjustment is required in the opening balance of retained earnings. Previous year's adjustments should be related adjustment should be incorporated in the opening balance of retained earnings, and current year's adjustment will be reported in the current period. And prospective means you need to apply the change from the date of change. So for future periods, you need to adjust. So there is no need to adjust the previous years or the opening balance of retained earnings. Then this will be prospective treatment. But in the retrospective treatment, you have to adjust the previous year as well. So let's take an example. Now please read this part of the question. So forth. In case when we put the please read note number 6. Now the question said it is discovered that in the previous financial controller of the Dublin engaged in the fraudulent financial reporting. Currently, 2.5 million receivable has been deemed to not exist, required to be written off, and 0.9 million related to the year end June 2008 and 1.6 million related to previous years. So the simple treatment should be income statement debit because it's a loss, retained earnings opening balance debit, and receivables credit. So receivables should be credited with 1.5, retained earnings opening balance will be 1.6, and income statement we need to guard 0.9. So this will be reported in the current year's income statement, and this will be the adjustment of the opening balance from the retained earnings. It is reported in SOCI, statement of changes in equities. Very good. Is it clear now? Now, one more question for you guys. Note number 3. Yeah, in the retrospective adjustment, we always adjust the retained earnings. Yes, 116 million will be adjusted, deducted from the retained earnings. So the question is triage, note number 3. Yeah, is it done? In September 2005, the triage company discovered a fraud in total. 700,000 is included as receivables in the above tolerance and be stolen by the employee. 450 of this relates to the year ended 31st December 2005 and the rest to the current year. So the accounting entry should be income statement debit, retained earnings, opening balance debit, and trade receivables credit. The amount is 7 lakh. 450 is related to the previous year, and 250 will be recognized in the current year. The directors are hopeful that 50% of the losses can be recovered from the company's insurance. The directors are hopeful. So when the chances of the recovery is virtually certain, then you can only recognize this amount. Yeah, this question is related to the ACCA. So it says the directors are hopeful. No, 50% is not the percentage for the probability. It is saying that whatever amount that you have incurred a loss, your 50% of the loss will be compensated will be by the insurance company. But the percentage can be determined from the expectation of the director. So directors are hopeful that their loss will be recovered. So you cannot recognize anything until the chances of the recovery is virtually certain. Okay. So there is no contingent. Yeah, it could be disclosed. This could be disclosed as a contingent asset in notes to the account. So one more question for you guys, and then we will move on. What will be the treatment of the questions they had? What is it? If it was mentioned that the chance of the payment is virtually certain, then you will need to recognize separately uh, receivables and the income from the insurance company. So the treatment should be receivables debit and income credit. Virtually certain means the chances of the recovery from the insurance company should be more than 95%. So the answer for this question number 8 should be A. The answer for this part of the question is A. Yeah, accounting estimate is something that involves the future, like future useful life of the asset is an accounting estimate, scrap value is an estimate, net realizable value is an estimate, method of depreciation is an estimate. So whenever you're talking about the accounting estimate, that must be something. There must be something that involves the future estimation, future predictions, future valuations. So revising the remaining useful life of an asset is an accounting estimate. But accounting policy involves some rules, some principles, and some presentations. So if there is some rule that you need to follow, like FIFO, FIFO is the first in, first out. That's the rule that you need to follow. Presentations, that we are charging depreciation in the cost of sales. This is a presentation format. The presentations and the rules should be considered as a policy. So the right answer is A. If you need any explanation in any option, you can ask it immediately. But when you are doing the practice, you need to do this practice like this, that if right answer is A, then you should know why A, B, and C is wrong. B, C, and D is wrong. Why not C? Changing the value of the subsidiaries inventory in line with the group policy of inventory valuation when preparing the consolidated financial statement. These are adjustments related to consolidation. So these are not accounting policies. If we switch from FIFO to FCO, and there, where it will be treated. If we are moving from FIFO to FCO, that it means that there is a change in accounting policy. So it should be accounted for retrospectively. So its impact should be adjusted in the retained earnings opening balance. That's it. In line, it says that it is in line with the group policy. This is not an accounting policy. It does not mean that if you see a word policy in any sentence, then you should know, you should say that this is an accounting policy. Uh, the wording is actually manipulated from the examiner side. Switching from the reducing balance method to the straight line, changing in the method of depreciation is actually an accounting estimate. Cost model to fair value model is a policy. What will we do in retrospectively meaning working? As I said previously, that whenever you need to adjust something in retrospectively, then the previous year's related adjustment will be dealt in the retained earnings opening balance, and current year's impact will be reported in the current year's income statement. So I think I have given all the answers. Let's move on towards the topic IS 37. IS 37 is about the provisions mainly. Provision means a liability with uncertain amount or time. So when the time period of the liability or the amount of the liability is uncertain, then you can say that this will be considered as a provision. So bank loan, is it a provision? Do you think that bank loan is a provision or should be covered under the scope of IS 37? The answer is no. Why? Because there is a clear certainty about the amount that you have borrowed, say for example 5 million. So you know that what is my total actual liability. So you need to return 5 million plus interest. So the amount is certain in this transaction, and bank has provided you 2 years time to pay the loan. So the time period of the loan is clearly certain. So only the liabilities with uncertain amount or time should be recognized as a provision. Right. So when we can record a provision, there must be three criteria that should have to be met. The first thing is there must be a present obligation arises from the past event. There must be some past event that will create your present obligation. Your past event could create your legal obligation or constructive obligation. Legal obligation means the obligation that was created by the operation of law, and the constructive obligation means the obligation that was arises because of the policy, the established policy. So if that event was occurred, then it means that your obligation is present now. The chances of the payment should be probable. The chances of making the payment should be probable means 50% more chances. So 50% is not exactly probable. Probable starts from 51%. And the amount can be measured reliably. So there must be a reliable measurement for the amount. So if these all points are met, then it should be recognized by debiting the income statement and crediting the provisions. Income statement debit and provision credit. But you can also capitalize the amount of the provision in one situation, and the situation is related to IS 16, when you need to incur the cost of dismantling and site restoration in the future. Then this type of provision can be capitalized. Do remember this point that long-term provision should be measured at the present value. Long-term more than one accounting period provision should be measured at the present value. Now, with respect to the amount should be measured reliably, the third point, provision should be measured at the best estimate of the expenditure. So, for single obligations, the answer should be the most likely amount. And for large populations, the amount should be the expected value. Is it clear? Example. Suppose you have entered into a legal court case because of some damage, because of some damage to the customer. The customer has sued you, and there is a legal court case running between you and the customer. So when you contact with your lawyer, lawyer A says that you need to pay 6 lakh rupees in order to settle this court case. Lawyer B is saying that you need to pay 8 lakh rupees in order to settle this case. And C is saying you need to pay 9 lakh rupees in order to settle this case. So different legal experts are giving me different opinions. But what is the probability that I need to pay 600,000? So probability of this case is 50%. So there are 50% chances that I have to pay 6 lakh. There are 30% chances that I have to pay 300,000, 800,000. And there are only 20% chances that I have to pay 900,000. So these are the probabilities of the payments. So if the court cases are normally single obligations that does not involve a lot of cases at the same time. So usually one or two cases occurs in a year or after 5 years. So if you are having a court case with some customer or the supplier, this could be considered the one-off event, single obligation. So the amount can be measured at the most likely outcome. Most likely outcome means the chances with the maximum payment. The maximum chances of the payment is 50%. So my provision should be made at 6 lakh. But if the situation is for the warranty, so you knew that I have sold a lot of products. For example, Apple company has sold so many cell phones. Samsung has sold so many cell phones to the customers. So they give the warranties on their products. So the claims for the warranty can be in large population. So these are large population situations. So the expected obligation could be 6 lakh, 8 lakh, or 9 lakh. So there are 20% chances that you need to pay 9 lakh. There are 30% chances that you need to pay 3 lakh, 8 lakhs, and there's 50% chances that you need to pay 6 lakh. So the provision should be made at the expected values. Expected value range, so the weighted average percentage. So 50% of the 6 lakh will be 3 lakh, 30% of 8 lakh will be 2 lakh 40,000, and 20% will be 1 lakh 25. So by adding all these figures, got the value of 7 lakh 20,000. The provision should be made with 7 lakh 20,000 for large population. Where is 50%? Where is 50% mentioned in the question? No, this is actually the 50% is actually the estimation of the amount. This 50% is different from the 50% of the probable situation. That 50% in which the second point is related. Now, I'm repeating this point again. Here, there is a probable outflow means whether the chances of making this payment, whether we need to pay the amount or not, so whether the chances of making the payment is more than 50% or not, that's a different thing. Right now, we are measuring the amount. In this example, we are measuring the amount that it is probable in this situation that you need to pay. That is decided and you need to pay. So how much to pay? So how much to pay will be based on the percentages. So these percentages are different from the probable and possible and virtually certain situations. So moving on towards the next point, then contingent liability and contingent assets. For liability and for assets. So there will be four situations: virtually certain, probable, possible situation, and remote situation. Virtually certain means 95% plus chances of the payments. Probable means 50% plus till 95% chances of the payment. Possible situation means 5% plus till 95%, 50% chance. So 50% actually occurs in the possible situation. And if the case is up to 55%, that means it's a remote case. So these are the four terms that we use. These are actually legal terms. So provision, in case of the liability, provision will be made at this level. So definitely in virtually certain we need to make the provision as well. But in possible situation we need to disclose this as a contingent liability. Disclose this as a contingent liability. And in the remote situation, you do not need to do anything. Do nothing. No accounting entry, no disclosure. In case of assets, like in the previous scenario, we were talking about the insurance claim. So in case of assets, if the chances of the receiving the payment is virtually certain, then you can recognize asset. Recognize assets. In case of probable situation, you can disclose, and in these two situations, you need to do nothing. That's a very important table. Provision in IS 37 is reported as a liability in the balance on the balance sheet. Contingent means future uncertain situation. Yeah, in case of liabilities, only the probable liability will be reported. Probable or virtually certain liability will be reported, but possibly Possible liability should be disclosed. No, we should recognize provision. Provision is also a liability. Contingent assets, these are contingent assets in which we are going to disclose. %50 means possible. You can see on the screen that I have written 50% plus for probable. Actually, these are all situations of contingent asset and contingent liability. So the virtually certain we book, we recognize the contingent asset actually. So these all are contingent assets. The contingent assets can be recognized or it could be disclosed. It depends on the percentage. So we recognize the contingent asset only when there is a chance of the receiving the payment is virtually certain. So there is a question for you guys. Please do attempt this question. I'm giving you just 1 minute. Now, let's start the point. On 1st January 2008, Duggan has notified that an ex-employee had started court proceeding against him for the unfair dismissal. Now, this is a very important part. We are a company. Our is employee is making a court case against us. And there could be a situation in which we are making a case against our employee who have done previously cheating or who have done some fraud. So if we are making a case against the employee, then there will be a case of contingent assets. Then you need to follow this part of the rules. But if the employee is claiming something from the company, so if we lose the case, there will be a contingent liability. So we will follow the rules for the liability. That's a very important part. So if we are suing the against the company or the employee is suing us. So legal advice was that there was an 80% chance that the Duggan will lose the case. So there are 80% chance that we will lose the case. So this case is more than 50%. So it is probable that we will have to make the payment. The accounting entry should be income statement debit and provision credit. So at an estimated amount of 1.012 after 1 year. So as I said earlier, that all future long-term obligations should be recorded at the present value. So Duggan has recorded provision of 800,000, but it should be recorded at the present value. So 1.012 into 0.9091. So can you calculate the amount? So it is actually 1.012 into 0.909, 920K. So company should record this provision at 920K, but they have already recognized it at a value of 800,000. So you need to do it to make adjustments of 120 extra. Secondly, starting from 1st January to the year end of 31st December, this liability will unwound in the future. That is called unwinding of discount. So this concept occur whenever we have to record the transaction at the present value. So as the time goes, we need to unwinding. We need to make the accounting entry for the unwinding of this amount. So the amount should be 920 into 10%. The unwinding of discount should be 92. So one more accounting entry should be income statement debit and provision credit by 92. So on the face of the balance sheet, this liability income in the income statement, there will be an amount of 120 plus 92. And in the balance sheet, there will be a provision of 920 plus 92. It should be a portion. The year end is for January. Whether the year end of the company is 30th June. Let me check the whole. Well, okay. As the year end of the company is 30th June, so this amount should be proportion 992 should be a portion for the classic. The discount will unwound for 6 months. So it should be 46. So these are the 4 to 5 more common and the famous case. How is the half year? Because the year end of the company is 30th June, which was not mentioned in the slide. But as the year end is 31st December, June, 30th June, so we need to take the proportionate amount for the 6 months. So these are some specific cases for the provision, which will help you in the examination. Provision will always be made for the overall cost. So, sorry, for the warranty cost. Provision. It's always probable that we need to make the provision for the future operating losses. We never recognize the provision. For overall cost, we never recognize the provision. For the owner's contract, we recognize the provision, but with the amount of loss. For restructuring, we recognize the provision only when the two criteria are satisfied. First, there must be a formal plan for the restructuring, and the plan should be communicated to all stakeholders. Environmental provision only when you do the environmental damage. If it is a long-term damage, it should be recognized at the present value. So these are the cases for IS 37 provisions. Onerous contracts means unavoidable loss-making contracts. Overall means major maintenance cost in which we usually upgrade our machines. So I think it's done now. So this will be the format for the income statement. Now, what are the mistakes that usually people do when they prepare the financial statement? The first thing, they miss the name of the company, which is very important. Then the statement, name of the statement, then the time period, then this precision level. Mostly students forgot to write this precision level. Some are using O in place of zeros. So we never use O here. It should be dollar cost of 3 zeros. Revenues, cost of sales, gross profit, distribution expense, operating expense, income statement, finance cost. Now the and gain on the revaluation net of tax. Should be reported notes here. Now the most important thing when you are showing your answer in the CRQ workspace, you cannot punch your answer in the cell. Suppose your answer is 45,000. So you cannot write 45,000 directly, otherwise examiner will give you 0 marks. That's a very important point. If a company has a plan for restructuring after 2 years and the plan is communicated to all stakeholders and there must be a formal plan, then yes, we should recognize the provision at the present value. Yeah, I will show you how to write this point. Okay. Examiner will give you 0 marks if you write directly 45,000. So what examiner wants from you? Examiner from you to show the working that how for this 45 comes from. So it could be 20,000 plus 25,000. So when you press the enter, the answer will be 45. So that's right. But examiner will check your answer by placing the cursor on this cell. If he will not get any workings behind this cell, he will give you 0 marks for this. So that is one of the biggest reason for the students who got failed between the range of 40 to 50, 49. Or if you have done already working, you only need to give the cell reference. Suppose it will be C7. Just give the cell reference rather than showing working one here. Do not need to show any working one here. Just give the cell reference here. So when you enter the amount, it will be directly connected with your answer in the working, that is 45,000. So that is one of the biggest mistakes that the students are doing in making the, okay, if something is given to you directly in the trial balance and there is no adjustment for that amount, so that amount is the only thing that you can punch on the Excel sheet. Otherwise, you cannot type any of the single amount, or if you write anything, and if you give even the working reference, examiner will give you 0 marks. Total amount like -10 plus 10. You can, no, you should not do this as well. Let me give you an example on the Excel. Let me show you for the clarity. I make it more visible. Now, suppose if I write like this, sales 10,000 plus 20,000 plus 30,000, bracket close. This is what most of the students are doing, and your answer is 60,000. Examiner will give you 0 marks. Don't remember this one, because examiner check your answer by placing the cursor on this cell number. So when they go in the cell number, there will be no working supported for this particular 60,000. So from where you got the 60,000? So do not need to show the working in this column. So it's better to write the answer like this, is equals to 10,000 plus 20,000 plus 30,000. That's it. You will get the answer 60,000. So when the examiner go on this particular link and compare this with this these two cell number, so when the examiner go on the C4, he will not find any working for the C4. But when the examiner goes on this working, we will understand, yes, 60,000 is calculated by adding 10,000 plus 20,000 plus 30,000. So, okay, that's why I will give you 2 marks for this. Or suppose you have done the working here, like 10,000, 20,000 and 30,000. That's what you have done already working. So you have done the sum formula by adding these figures, you got the value of 60,000. So now you need to report the sales figure by giving the reference. So all you need to do is to just click on the just type the equal to sign and go on that particular cell number in which you have already calculated 60,000. So if you calculate this in this manner, then your answer will be assumed to be, assuming that's working one. So if you write like this, like sales, I have extracted from working one and it's 60,000. Examiner will give you 0 marks. Examiner has no time to go and search where the working one is. So as compared to this part, when he clicks on the link, that shows you need to go on I7, I10. So you can clearly go on I10 and you can check the photo. So when you click on this link, it will be highlighted in the working one that this is I10. So examiner will check the answer. Yes, okay. You have calculated 60,000 by adding these three figures. Okay, that's fine. 2 marks. Are you getting this point? Now let me show you some more tips about constructive response workspace, CV specimen. And I'm telling you how to solve this. And constructive response workspace. Click on the link. So a separate window is open for the Pearson view. Next, then yes, I have read all these points. Next, 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 next. Then again next. Then next. And that's the format. So we go in the navigation bar and search spreadsheet question. Now that's the spreadsheet question. So when you are solving the question, first select A, B, C, D, any particular column and color it all and make a small wall for this. So there is a separation between the workings. So all the workings will be performed here. So working one or working two or whatever you are using. Then when we come for the final presentation, now first you need to write the name of the company, that is Duggan. Then statement of, suppose the requirement is a statement of profit and loss. Statement of profit and loss for the year ended on 31st March 21. So that's the name of the question. Make it bold to be more presentable, and then go on the last column, type the $sign here and use apostrophe. If you write 000, your answer will be 0. So you need to write an apostrophe first in the bracket with the $sign and then add 3 zeros directly. So it will be the precision level. Or if you are writing the answer in millions, just write M here instead of this. Make it bold so that it will be prominent. Now sales. Assuming there is no adjustment in the sales figure, so you are picking the figure directly from the trial balance, and there is no adjustment in the sales, so our answer will be 900,000. Then your cost of sales. If you have calculated this figure, so write this figure with the negative sign. So assuming that you have already calculated this figure from in working two, assuming, and we just go and write 75,000. So we have picked the figure from. So do not do not make the income statement too much close all the rows so that it will be very much difficult for the examiner to understand. So make a one line difference and write gross profit here. Now you just go and by adding these two figures you will get the value answer. Now, now the students ask me to show the accurate presentation for this paper. So you have this particular option for the presentation and you can go and select this one. So when you go and select this option, your answers will be so if you select the first one, your negative values will be reported in the red color, but we do not need to show the figures in red color. And if you opted the second and third and fourth one, then these will be with the decimal places. We do not need to show the answer in decimal places. So you need a 0 decimal place working. So your answer should be with this format. So just select the gross profit and just make it bold and little bit italic, and you can just underline this figure. So this answer is seems to be more presentable as compared to if you write all the answer without any proper format. So I hope you are getting what I'm trying to say. Yeah, there are marks for the format exactly. Is the format and the order important? Yeah, order is important. The format is important. Credit workspace. Can we add rows and columns? I didn't get your question, Osama. What you wanted to ask on net profit is incorrect. Okay, one more important thing. We never use the word net profit for the companies. This word was obsoleted in 2003. So we need to use the word operating profit, or we can use the word operating profit for the PBIT. And after finance cost, we calculate the profit before tax, and after taxation, we will calculate the profit for the year. So it's a good sign, it's a good point for the students that examiner will never give you the marks on totality. So if your total is wrong, that's not a problem for the examiner. Examiner will give you marks both on the steps. Like if your revenue is correct, you will get 1 mark. If cost of sales is correct, you will get 2 marks. Distribution cost 1 mark, 1 mark for the administration. Finance cost 1 mark. So there is no marks for these profit figures. Income tax is done correct, yes, 1 mark. Revaluation gain is correct, yes, 1 mark. This is how examiner do the checking the examination. Scratch pad, you can use the scratch pad, but I think there will be no need for the scratch pad. Usually in exams, some exam centers, they provide a pen and a paper for the workings. So are you getting the the key points for how to make the formats, how to present the income statement? The income statement should be in this line. So if you wanted to add any sort of other income, any gains, or it should be reported before the finance cost, because after the finance cost we only have the income tax expense and then we got the value of profit for the year. Even if you write the word net profit here, that means that you are in the non-compliance of IS1. Can we add new rows or columns in that? No, you cannot add rows and columns like you do in Excel. Where do so to explain where to show the interest. Investment income should be reported just before the finance cost. So similarly, if you have got the finance income or any other investment income, it should be reported just before the finance cost. I hope you all are getting these points. So now your assignment is to solve all these 4 questions. The first one is a Duggan. You can just type it on the Google. These are the questions on the past papers. Duggan is your assignment, number 1. The second question is Vernon, that you need to just solve this question on the constructive response workspace. Take the snapshot of your formats and send it to me. You can check your answers from the past paper answers as well, but your format, I can only check your formats based on the pictures. Haverford, third question, and triage. So these 4 questions are more than enough for final account preparation. On the constructive response, yes. Duggan done, Haverford done, Vernon done, and triage done. Okay. So don't use notebooks or Excel. You have to solve all the questions on the CRQ workspace. So you should be very much familiar with all the tools that is available here. You should know this, that why we use this. These are used for the if you wanted to make your answer in a decimal places. This is the percentage. This is will be used for the fraction. Format as date and time over. So these are all related tools that you should know how to write your answer. If you have done all the question issue on the CRQ workspace, then it's fine. But if you have done these questions previously on the notebook or Excel sheet, then you need to do it again. No, you cannot use the short words. Short keys are some of the short keys are used like Control B is used for to bold the data, or Control I is used for to make things italic, but there are very few shortcuts that is available. So let's start the new topic, that is consolidation. Yes, you can use the word NCR. That's fine too. So let's start with the new presentation slide. You can download the handouts from the handout section. So you have written 900,000. Yes, this actually 900,000 is actually 9 billion. So if the figure is 9 million in total, then you have to report 900 already, because we ignored the 3 zeros. For the questions for the home assignment, there are 4 questions, Duggan, which is available in my practice handout. Duggan, Vernon, number 2, Haverford, number 3, and try it. Do not go to do further practice for the final account. I think these 4 questions are more than enough. So let's start the new topic, consolidation. And before starting this, I need a break of 5 minutes. So I need a break of 5 minutes right now so that we can start the new topic with the new energy. So let's take a 5 minute tea break, then we will start working. Hello, welcome back again. I hope you all are present. Please write yes in the chat box so that we can start the session. The topic is consolidation for today. So consolidation. First, the first question is, what is consolidation? Consolidation means the preparation of financial statements of a group. So when you prepare a financial statement of a group, then this concept is called as a single economic entity and it's called consolidated financial statement. Now the group means a parent and its subsidiaries. So a group can have many subsidiaries as it can, as if they want, but the parent in the group must be one. So all the other members of the group are required to prepare their own financial statements, but the parent company is bound to prepare its own financial statements as well as the financial statements of the group. So in fact, it is the parent company who do the consolidation in addition to the preparation of financial statements of its own company. Now, subsidiary is a company controlled by another entity, and the parent is an entity which controls one or more subsidiaries. So the relationship between the parent and subsidiary exists only because of the control. So if nothing was mentioned, then we can take the percentage, which is more than 50% ordinary shares. So the main criteria is not the percentage, it is actually the control. So the control is important for making a group, and the company who's controlling the subsidiary is called parent, and the company who's being controlled by the parent is called the subsidiary. So control is the power to direct the relevant activity. Relevant activity means the overall decision making of the company. Who is giving the direction of the overall decision making of the company will be the controlling part. So is it possible that you have got 10% shares in B company and this will be a subsidiary? Is it possible that you have got 10% shares in B company and B is your subsidiary? So the answer is yes. It is possible that B company is your subsidiary if you have got the control. It all depends on the control. So by whatever means, if you got the control, then you can exercise if you can exercise the control over the other company, then that company will be a subsidiary irrespective of the percentage. Similarly, is it possible that you have acquired 90% shares in a company and this is not your subsidiary? Is it possible? So the answer is yes. This is again possible if you can't control company B, but you have got 90% shares in B, then this will not be a subsidiary company, even if you have got 90% shares. So what is important is the word control rather than the percentage. Next part. Now, what is control? According to IFRS 10, control means an investor controls an investee if and only if the investor has the following three elements. The first one is the power over the investee, exposure or right to variable returns, and the ability to use the power. So if the 3 points are met, then you have the control of the other company. So these 3 points can be examined in theoretical questions with related to consolidation. Now, there is another company called the associate company in which you'll be having a significant influence. So significant influence means when you have got the power to participate in the policy making process, and 20% or more shares is required to make a significant influence. Now, so there can be three situations. The first one is control. The second one is the significant influence. And the third one is no control, no significant influence. Nothing. So if you have got the control of a particular company, then this will be considered as your subsidiary company. If you have got the significant influence of the other company, then this will be your associate company. And if you have nothing, then this will be your simple investment. The accounting standard that governs the accounting treatment of consolidation subsidiary is IFRS 3, IS 28 for the associates, and IFRS 9 for the simple investments. The percentage that we normally assume for this situation is if we have got more than 50% shares, 20% more or more, and less than 20%. The accounting treatment for this situation will be we do the consolidation for all the subsidiaries. So this is the accounting treatment. Associates will be accounted for under equity method, and investments will be accounted for under IFRS 9 at fair value method, which could be fair value through OCI or fair value through P&L. Is it clear? Now, next word is NCI. NCI is actually the remaining interest in the subsidiary company after deducting the parent share. The parent company has acquired, suppose 80% shares, then 20% share will be for NCI. Because parent company can control the subsidiary company, so there are parties who have got the interest in the subsidiary but they cannot control. So that's why we called it non-controlling interest. Moving on to the next slide. Now that's the question for you guys, in which examiner has asked which of the following will be treated as a subsidiary. Which one is a subsidiary out of these three? We have 30 seconds for this question. So the right answer for this question is, let's sort out. The acquisition of 60% share of Zacron equity shares and share capital on 1st January 1st March 2007. The Zacron activities are significantly different from others. Now, this is again a very important point. You will not get the exemption from the consolidation if the activities of the parent and subsidiary are different. So there can be different businesses of the parent and subsidiary company. So this will not going to impact on any of the provisions of consolidation. It's not compulsory that parent company is a bank, then subsidiary company should also be a bank. It could be any other company. So, so that's why one is subsidiary. Now the second part is there is an offer to acquire. That means that we have not yet acquired this company. So that's not my subsidiary right now. The acquisition of the 45% speech equity shares is able to appoint 3 out of 10. So you will be in a position to appoint or remove minority of the directors rather than the majority. So that is significant influence, but it's not control. So that's why 3 is wrong. So the answer will be A. Second question. 30 seconds for this. If it is was 8 out of 10, then it will be. If you have got the right to appoint or remove the majority of the directors, so even if it is 6 out of 10, then it will be a subsidiary. 5 out of 10 associate, 4 out of 10 associate, 3 out of 10 associate. But if it is more than 6 out of 10, then it will be subsidiary. And why 2 is not the right answer? Because of the fact that we have not yet acquired that company. It's in the planning stage that we wanted to acquire this company. So we have not yet acquired this company. That's why this is currently at the reporting that this is not our subsidiary. So if 49% and a negotiation to acquire more than 20%, then it will be subsidiary. No, if you have got 49% shares and there is a negotiation going on, but you have not yet acquired that part of, then it will not be considered your subsidiary till the time you have acquired the majority of the shares. Or even if you have got 49% shares and you have the power to appoint or remove majority of the board of directors, or you have the power to rule the company, then that will be a subsidiary. Yeah, even if they say 45%, it could be a subsidiary if you are ruling the company. So the answer for this question is D. So D is the only situation in which you will get the exemption from the consolidation. Otherwise, in all three cases, you need to perform the consolidation. So it is actually the control which is important in this whole scenario. See, the delta is located in a country where the local accounting standards are compulsory and are not compatible with the IFRS. So if the parent and subsidiary companies are located in the different countries who are following different accounting standards, then you will not get the exemption from the consolidation. So it is the parent company who has to prepare the consolidated financial statements after adjustment of the subsidiary company's financial data. So you will get exemptions from consolidation only when you lost the control of the subsidiary. Now, in the consolidation, there is a concept called unrealized profit. So unrealized profit means the profit that has been earned by the parent from the subsidiary, or from the subsidiary towards the parent, or there could be an associate. So this sort of profit which will not be recognized in the consolidation, and that is called unrealized profit. So what you need to do is to reverse that profit amount, because we are assuming that parent and subsidiary companies are single economic entity, one unit. So if you are a single economic entity, then how come you can earn profit from yourself? So therefore, in consolidation, we always remove all type of profits which has been earned from the parent to the subsidiary, or from the subsidiary to parent. So the unrealized profit will be the profit in the original transaction multiplied by percentage of the stock still in warehouse. That's the formula if there is a transaction between parent and subsidiary. But if there is a transaction with the associate, the initial formula will be same, multiply by percentage of stock still in the warehouse, multiply by associate percentage. So we use the associate percentage in order to calculate the profits. Now, there could be four possible situations: that the parent company sold goods to the subsidiary, subsidiary to parent, parent to associate, subsidiary to associate, associate to parent, and associate to subsidiary. So there could be these six situations that might occur between the parent, subsidiary, and associate for unrealized profit. So all of you are required to make the double entry for the unrealized profit in all these six adjustments. So I'm giving you just 1 minute to write double entry. WH means warehouse. Now, the first case is from the parent to subsidiary. If the parent company has earned the profit, the accounting entry will be retained earnings debit and stock credit. If the subsidiary company has sold, so the accounting entry will be retained earnings and NCI debit and credit stock. From parent to associate, retained earnings debit, investment and associate credit. From subsidiary to associate, retained earnings debit, NCI debit, stock credit. Sorry, investment credit, associate credit. Retained earnings debit, stock credit. And retained earnings debit. So these are the all accounting entries. Stock means inventory. Yes, from subsidiary to parent, whenever the subsidiary sold goods to anyone, the profit will be distributed between the group and NCI on based on their percentages. If the associate is selling inventory to someone, the accounting entry will be retained earnings debit, stock credit. But if the associate company is buying, because we cannot consolidate associate companies' financial statements, therefore everything related to the associate inventory should be adjusted in investment in associate. So any adjustments that is required in the books of associate should be treated in investment in associate. Yeah, it's stock or inventory is similar. These are for SFP, Consolidated Statement of Financial Position. Now, now the question is, at what value we should report the consolidated stock? Consolidated stock should be reported by adding the parent companies and subsidiary companies stock. Plus, if there is any fair value adjustment, then it should be added here. Then unrealized profit plus goods in transit. This is the format that we use for stock. The second is property, plant and equipment or any other intangible asset. We need to add parent asset plus subsidiary plus minus any fair valuation adjustment plus minus depreciation. That is the GIT means goods in transit. So if there are some goods which are in transit, then it should be capitalized. Fair value adjustment in stock means if at the date of acquisition there might be some adjustments in non-current assets or in current assets, it could be in stock. So if that at the date of acquisition, because IFRS 3 says that at the date of acquisition, all the assets or land liabilities of the subsidiary should be measured at the date of acquisition, at the fair value. So there could be a fair valuation adjustment in any asset or any sort of liability. Yes, goods in transit will be added in the closing stock, which will be reported in the SFP. In which scenario will we add depreciation? Do remember this point. Whenever there is an upward revaluation, fair valuation adjustment is upward, then depreciation should be deducted. But if there is a downward fair valuation adjustment, then depreciation should be added back. IA means intangible assets. So I'm talking about the tangible and intangible asset at the same time because both will be reported with the same pattern. So that's tangible and that is intangible assets. Coming towards the receivables, trade receivables reported as parent plus subsidiary minus cash in transit minus current account adjustment. Cash will be reported, cash or bank will be reported as parent plus subsidiary plus cash in transit. TR means trade receivables, or you can call it as debtors. Please do copy all these points. Current account means intercompany receivables and payables. If there is some receivables between the parent and subsidiary, then it should be cancelled out. That is current account. Now here is a question for you guys. All of you are required to just read this question and write the accounting entries. Now, let's solve this question. After the acquisition, Penkit sold goods to, in Penkit, you can see here is a parent company. Penkit sold goods to Sphere. Sphere is a subsidiary company for 20 million. And you can see here that one fifth of these was still in the inventory. So how we can calculate the unrealized profit? All sales in Sphere and Venture had a markup of cost 25%. The 20 million is the sales price. It should be divided by 125 multiplied by 25. You got the value of the profit out of total 20 million. So when I divide 20,000, 20 million divided by 145, 125 multiplied by 25, we got the value of 4 million. So 4 million is the total amount of the profit that we have earned out of this 20 million. But only one fifth means 1 upon 5, which is equivalent to 20%. Only 20% of the stock is still held in the warehouse. So the amount for the unrealized profit will be 0.8 million. And the accounting entry should be retained earnings debit 0.8 and stock or inventory credit by 0.8. Is it clear? Yeah, unrealized profit must be on the inventory which is still held. Now the next point is Pankit also sold goods to Venture. Means Pankit sold goods to associate company because it has got 30% shares in Venture for 15 million. And how we can calculate the profit from this 15 million? 15 divided by 125 multiplied by 25. So when I divide 15 by 125 multiplied by 25, we got the value of the profit, which is 3 million. So 3 million is the profit that we have earned from, and it says that all of which were still in the inventory. It means 100% is still held in the inventory. But for the associate, you need to apply the associate percentage as well. The amount will be 0.9. Sorry, 0.9. The accounting entry should be retained earnings debit by 0.9 and debit. Credit should be investment in associate by 0.9. No, if you are confused about whether we should give the profit percentage to NCI, then think about it that who have earned the profit? Who has earned the profit? Either the parent or the associate or the subsidiary. So if the parent has earned the profit, there is no share of NCI in the parent's profit. So when the parent is selling goods to subsidiary or to associate, there will be no concept of NCI, because the concept of the NCI only arises when the subsidiary sold goods to parent or associate, because subsidiary's profit will be distributed between the group and NCI. If A to P will be shown in investment, no. Only P to A or S to A will be reported in investment. Is it clear to all of you? Why in parent share value? Actually, we only take uh, we only take your share of profit in associate company to the extent of the shares that you have acquired. So if you have acquired 30% shares in associate, you can only book 30% of the profit. So therefore, whenever you are going to adjust the unrealized profit, you can only adjust the 30% of the profit because you have nothing to do with the remaining 70%. Yeah, if A sells to P, there will be no impact on the investment in associate. I have shown all the accounting entries here. I think you can take the snapshot of the previous slide if you want. Only the investment in associate will be affected when the associate company is buying the goods. So it should be divided by 5. 1/5 means 1 upon 5. So 1 upon 5 is equivalent to 20% as well. So that's why we take the 20%, or you can use the fraction 1 upon 5. Now here is a question for you guys. Please do attempt it and reply your answers. These are one of the toughest exam questions of the past papers according to the examiner's report. Yeah, my slides are available in the handout section. You can download my all the handouts and slides from the handout section. We would deduct the sale amount from the inventory, no, and add back the URP back to the inventory, right? No. I think you again missed the formula that I have written here. Just check this formula, that whenever you are going to calculate the consolidated stock, you need to add parents and subsidiary company stock plus fair valuation adjustment minus unrealized profit. So sales and purchases has nothing to do with this particular closing stock, and plus goods in transit. That's it. That's the whole formula that you can use for the calculation of the closing stock. Now here is a question for you guys. Please do attempt it. Okay, what's the right answer for this question? You need to add the parents and subsidiary company's profit in order to calculate the total consolidated inventory, and there will be an adjustment of 2 lakhs. That is the fair valuation adjustment. But as the company has sold 70% of the stock, so there will be only 30% remain in the inventory. That will be 60. The answer for this question will be 3250 plus 1940 plus 60. The answer is A. Is it clear? Very good. Actually, there is a fair valuation adjustment of inventory from 600,000 to 800,000. There is a fair valuation adjustment of 200,000. This is not an unrealized profit case. This is a case of fair valuation adjustment. But out of this 200,000, company has already sold 70% of the stock to outside the group. So at the reporting date, at the balance sheet date, only 30% of the stock is still held. So you need to adjust only 30% of the stock for the fair valuation adjustment. That is 60. I hope it's clear now. Now the next concept is goodwill. No, we do not need to take. We never do. We never apply percentage proportionate. Sorry. We never proportionate balance sheet items. Like the inventory cannot be reported at 3 upon 12. It is actually the income statement item that can be proportionated if the acquisition was made during the year. The balance sheet will never be based on the time period. Do remember this one. Now, for the goodwill, IFRS 3 says that you need to calculate the amount of the goodwill for the balance sheet. So the first thing is the cost of investment. Then NCA acquisition should be added. We will get the value of total value of the business. And it should be adjusted with the fair value of net asset at acquisition, and we've got the value of goodwill at acquisition. And after the impairment loss, there will be goodwill at report. So if the examiners clearly states you to identify the goodwill at acquisition, so you do not need to deduct the impairment loss. You only report this goodwill before the impairment. But if the question is specifically mentioned you to identify the goodwill at reporting or at the year end, then you need to deduct the impairment loss first after reporting the amount. PURP is not adjusted. PURP is not was not given in the question. That's why we didn't adjust the PURP. Now the next point is how we can calculate the fair value of net assets at acquisition. So by adding just 4 amounts: share capital, share premium, revaluation reserve, plus retained earnings, plus minus any other fair valuation adjustment. So these are the 5 items. When you add all these figures, you got the value of fair value of net assets at acquisition. Now, if the answer of this above question is in negative, then it will be considered as a bargain purchase profit. Gain on the bargain purchase, which should be reported in the P&L, profit and loss, as your income. No, share premium, do remember this point. Share premium should be included in the fair value of net assets, but it should be the share premium of the subsidiary company. We never take any of the values of the parent company in order to calculate the fair value of net assets, because we are calculating the fair value of net asset of subsidiary company. So all the figures should be for the subsidiary company. And the most important point here is that these three items, revaluation reserve, retained earnings, or fair value adjustment, these three items must be at the date of acquisition. So can we use any format to calculate the goodwill? Yes, this is the format to calculate the goodwill. Now this is the formula again. Cost of the investment plus NCI less fair value of net assets at acquisition. We got the goodwill at acquisition, and after the impairment loss, we got the value of goodwill at the reporting date. So here is the question for you. You are required to calculate the goodwill in this question. Yes, the cost of the investment is 1,000, ignoring 3 zeros. NCI is measured at 200, so the value of the business is 1,200. And when we deduct the fair value of net assets from here, we got the value, total value of 900 at acquisition. So we never take these values at the reporting date for the calculation of goodwill. We always take equity side of the subsidiary company at the date of acquisition. So the goodwill is 300,000. Okay. Now here's a question for you guys. You have just 10 seconds to solve this. 10 seconds. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Yes, the right answer for this is B actually. Wonderful. All incomes will be recognized on the credit side. So therefore, the answer is B rather than C. Because in the income statement, expenses are recorded on the debit side, but the incomes are recorded on the credit side. So negative goodwill is actually your income. So that happened in the examination when you have got the limited time period. You go in the panic and mark C instead of B. So you need to prepare yourself that how to perform in under pressure. Now, cost of the investments. There are certain situations in which examiner will give you a consolidated related questions in which you will not be given the accounting entries, or the transaction has not yet been recorded by the parent company. So you need to write down the accounting entries for this. So the cost of investment, negative goodwill is income. Yes. The cost of the investment means the payment that the parent company made to acquire the shares of the subsidiary company. So it is actually the payment that the parent company made to acquire the shares in the subsidiary company. These are the payments. So the payment could be partly in cash, in shares, in deferred consideration, contingent, or it could be in the form of a loan. So what is the requirement? So you should know how to make the accounting entries for this. The cost of investment debit and cash credit. If the question says you that the cash consideration has not yet been recorded by the parent. If the share consideration has not yet been recorded, the accounting entry should be the cost of investment debit, share capital, and share premium credit. If the case is for the deferred consideration, means part of the payment will be made in the future. The first entry that you need to make is the cost of investment debit, deferred consideration credit. This entry should be made at the present value, and at the reporting date, you need to make an accounting entry for the unwinding of discount. So the treatment should be retained earnings debit, deferred consideration credit. That is unwinding of discount. Contingent consideration means the part of the consideration which you will pay, which you will pay in the future based on some contingent event. So the basic difference between the deferred consideration and the contingent consideration is deferred consideration is an unconditional payment and contingent consideration is the conditional payment. So cost of investment debit, contingent consideration credit, this should be measured at the fair value. Any changes in the contingent consideration will be adjusted from the retained earnings. What about the loans and debentures? If it is a part of cost of investment, then the accounting entry should be cost of investment debit and loan credit. So these all could be the part of the cost of investment. How do we calculate for the contingent consideration? It will be given to you in the examination. You do not need to calculate the fair values of the contingent consideration. It will always be given to you in the examination. It is recorded in the consolidated financial statement. Payment of the deferred consideration is recorded in the consolidated financial statements. Yes, it will be considered as a liability. Both the deferred consideration and the contingent consideration is your liability, which should be reported in non-current liability. Yeah, the loan must have some interest value. Now here is the question for you guys, in which you are required to calculate the cost of investment and make the all accounting entries. Make all the relevant accounting entries. If there is a change in the contingent consideration, then it will be adjusted against retained earnings. Now I'm going to solve this. On 1st October, Pentel acquired 90 million shares out of 150 million shares. So the percentage can be calculated by dividing 90 upon 150. No change the goodwill. So the percentage will be 60%. So if the 60% will be related to the group, then 40% will be related to NCR. Now, The acquisition was achieved through a share exchange of one share in packet for every 3 shares in Sphere. So you have acquired 90 million shares of the Sphere, and you are going to issue one share for every 3 shares. So 1/3 will be the fraction. So you are going to issue 30 million new shares of the parent company. The share price, the stock prices of the packet and the Sphere shares were 4 and 2.5. So each share of the packet has a value of 40 million. 4. So the amount will be 120. So the accounting entry should be cost of investment debit 120, share capital credit with the number of shares, that is 30 million, and the remaining difference will be reported in the share premium, that will be 90 million. So when you are preparing the balance sheet, these two items will be added in the parent company's share capital and share premium, because the parent company has issued the shares against the subsidiary company. Then the company Benket will pay 1.54 cash for each share acquired. So we are going to acquire 90 million shares and we are paying 1.54 for each share acquired. So that what will be the total amount that we are paying? Please calculate the amount. What is the total amount that we are paying to the on 30th September after 1 year? 14. It's 138.6. And now you need to calculate the present value of this 138.6 into 1 plus 10% 0.10 is to the power minus 1. The amount should be 1,26,000. The accounting entry for this part should be cost of investment debit 126 and deferred consideration credit 126. And at each reporting date, you need to make the entry for the unwinding of discount. So if the time period has 6 months after the reporting date, then the unwinding of discount should be proportionate to 6 months. And if it is 1 year, then the accounting entry will be retained earnings debit and deferred consideration credit for the 1 year. So for the 1 year, the amount will be 12.6, the percentage of the present value. So if the 1 year has passed from the date of the acquisition, so the unwinding of discount will be. So you should remember this point, that the cost of investment will be added with 126, deferred consideration by 126, and the retained earnings will be deducted by 12.6, and 12.6 will be added in the deferred consideration. Yes, this deferred consideration, if it is payable after 1 year, will be reported in non-current liability. Otherwise, if it is payable within 1 year, so it should be reported in the current liability. Now, I think that so one more adjustment related to this. Sometimes examiner will ask you to calculate the NCA at acquisition. So the formula is very simple. You need to see how much shares that parent company has acquired and how much shares remaining for the NCI. So out of 9,000, if 5,400 shares was acquired by the parent company, so how much shares will be left for the NCI? It will be 9,000 minus 5,400, 3,600. So sometimes examiner tells you to calculate the NCI at acquisition. So you need to first calculate the number of shares of NCI into share price of the subsidiary company. Share price of the subsidiary company is given in the question, that is 1.5. So this is how we calculate the NCI at acquisition. So usually examiner gave you the value of NCI at acquisition. But if it is not given in the question, then you can calculate it by multiplying it by 1.5. So in the handout section, you will be having, let me open the handouts. From the handout section, there's a consolidation practice. These are the practice questions of consolidation, in which you'll be having a first question for the consolidated balance sheet. So this is the question, and all of you are required to calculate the assets. All of you are required to calculate the assets side of the consolidated balance sheet. So when you people come tomorrow, it's one of the assignment to do this question, only the asset side, and the equity side will be done tomorrow. So not what's your assignment? Your assignment number one, so your assignment number one is to follow the spatial plan that I have shared with you guys. Assignment number two is consolidation question for the balance sheet that I'm giving you. Only the assets are required. Assignment number three, 4 questions of final account. 4 questions of the final account on CRQ workspace. And assignment number 4 is to do the MCQs handout of day 1, 2, and 3. And I haven't shared day 3 practice handout with you guys. So I'm just sharing it on the WhatsApp group, and we need to solve these questions. Okay, well, so where are the mocks? Can we tell? Can you tell? The mocks will be provided to you on Friday, tomorrow. And tomorrow we are going to cover firstly the consolidated balance sheet and the income statement, and then we will be covering the topic that is ratios, ratio analysis. And the plan is available on the WhatsApp group. Please do send me the WhatsApp, just message me on the WhatsApp. I will share with you the plan. And there are students who wants the recording link of IS 33. I will share the recording links of IS 33 as well on the group. So, and if you wanted to ask any concept about this paper, you can call me in the morning time, or you can just privately send me the message. How many questions to do? I will tell you tomorrow for the consolidation what you need to do. But till today, we need to focus on these slides. And the second thing is you need to do all these assignments. Yeah, I'm just wanted to change working for the loan. So thank you so much for today's session, and inshallah we will meet tomorrow again on the same time. Till then, take care of yourself and do as maximum practice as you can. Don't worry about the EPS and IS 37 questions. I'm sharing it just with you guys on the group. Take care, Allah Hafiz.